Good morning, everyone, and it's my pleasure to join you for one of the sessions that we are having. So today and this morning, we'll be looking at accounting principles and concepts. So my name is Wasiu Babalala. The last class, we tried to look at the introduction to financial accounting in hospitality and tourism. We look at the definition of financial accounting. We look at the users. We look at also, apart from the users of accounting information, we look at the importance, and we look at the legal framework at which we operate in the hospitality and tourism industry through accounting. So today we'll be looking at accounting principles and concepts. Principles and concepts are things that guide the operations of accounts globally. So the objective of this class is for us to understand what is general acceptable accounting principle gap. I'm sure you remember we discussed this briefly during our last class. Also, we'll look at the double entry principle. We are going to look at the accounting cycle and how transactions are recorded. And we'll look at the difference between the accrual and the cash accounting concepts, which are known in the accounting world. So let's look at the gap, general accepted accounting principles. It refers to common set of accounting principles, standards, and procedures that companies must follow when compiling financial statements. Now, it means it provides the framework, it provides the rules, it provides the standard in which when you are preparing your financial statement, you need to follow. And when you are preparing documents for use, for acceptability by government, the government will require you to follow the GAP principle. Some countries use the standard accounting board standard, but all of them are extracted from the GAP. So this is generally acceptable globally. And we'll be looking at this when we go deeper into the class. We are conscious and we have the caveat that we are all hospitality and tourism practitioners. But just like I said, this is not to turn us into accountants, but also for us to understand what our accountants are doing. And so that when they report to us, we have an idea of the processes, the principles, the standard that is expected of those reports, and we will be able to fit in accordingly. So in setting up this accounting principle and standard, there are some key principles that are in it. One, the consistency principle, the going concern principle, the matching principle, the revenue recognition principle, and the historical cost principle. So we're going to look at each principle one after the other in their simplest form for our understanding. So before the consistent principle means if you are preparing your account, there is need to be consistency in the period that the account will cover. So it means if the financial account is being submitted on weekly, then there must be consistently that we get that report on weekly basis. Now, if it's a monthly account, there must be consistencies getting it on monthly basis. Not that one will be delivered end of January, another one will be mid-February, another one will be the third week in April. There is no consistency in that. It has to be, so there should be consistency in the time it is being submitted and the manner that is being submitted. For example, if you are submitting the report and the first thing that comes up in your reporting is revenue, and next month you are putting cost of sales ahead, there is no consistency. Second is the going concern principle, which says that the business, though is a creation of man, we need to understand that it's assumed that it will live beyond the person who has created it. Although it is seen as being separate from the owner. So it is assumed that it will outlive everybody. So it's going principle that, so when transactions are being made, that's why we allow for creditors, debtors. So it can hold, people can hold it. So you don't assume that the business will die today, except by order of the court or the owners are trying to wind down, it is assumed that the business will continue. Now, the matching principle means for every revenue must have something where it's coming from. If an expense is made, it must be matched. In fact, it must match where the money is. It must be related. So it means if I'm saying I'm buying an asset from the bank and I issue a check of 100,000, the figure that must be attached to that asset must also be equal to that 100. And it should be able to correspond to, okay, this is where it's coming. This money is the same as this. Now, revenue recognition principle also state that whenever you generate revenue in the business, you should be able to recognize where the revenue is coming, and also you should be able to recognize what you have used in generating such revenue. Having that in mind as a principle, we'll now look at some of the other concepts of accounting. One of the concepts we'll be looking at here today is the double entry system, in which it says that every transaction must have at least 2 accounts. And there is a general word we use with this, where we say you debit the receiver, you credit the giver. So that means when there is a transaction, it will always involve 2 people, 2 accounts. Somebody is the giver, somebody is the receiver. Okay, let's not even personalize. An item will be the giver and an item will be the receiver. And that's why we say you debit the giver, you credit the receiver. So we're going to see some examples now, but before we look at the example in the book, let's look at something more simpler. If I'm giving the class governor the sum of 1,000 naira, who is the giver? I am the giver. So you are going to credit Babalola. Who is the receiver? The class governor. You debit the class governor. And that is the way for every accounting transaction. There is always a giver and there is always a receiver. Now, let's go a bit practical. Now, if I am the CEO of my company and I decide to approve that they should go to the market to buy food that we're going to use in the kitchen for further production, and I authorize that the money should be taken from the petty cash, sum of 10 naira. Now, who is the giver? I am not the giver because I'm different from the business. So in the business, you now look at, okay, in the business, who is the giver? Oh, is the petty cash that is given. So we're going to credit petty cash and say, okay, what was this money meant for? Oh, purchases. Now, who is the receiver? It's not the person. Now, the person that has gone to the market is the receiver, but that person is not in our chart of account. Now, note this word, chart of account. Next class, where you'll be hearing from me, we're going to be discussing something similar to that for you to know what is called chart of account. Now, what the person has used the money for is purchases. That is what reflects in our account. Then we are going to debit purchases. Now, let's assume I'm the owner of the business and I decide to take 100 naira to go to party. 2 items are involved. Remember, the business will tell, okay, where am I taking the money from? Maybe from the bank. So the bank becomes the giver on behalf of the business. Now, who is the receiver? Me. But probably because I have money, I set up the business, then it becomes drawings against my capital. Then the drawings becomes the receiver. It's so simple. So once you have this concept, when things happen, you can say, okay, where is the second side of this transaction? Then once the second side is verified, then that transaction is complete. So let's look at the example here. And then you see when the company borrows $10,000, that means the 10,000 increases the cash, which is an asset, and also increases the liability, which is payable. But how do we treat it in the account? In our books, we debit the cash and we credit the person who has given us the money. for our books. So we quickly look at leaving the accounting, that's the double entry principles. We now move on to the accounting circle. And the accounting circles tells us the step involved in taking a transaction till when you close the transaction. So when somebody comes to buy from us, buy hotel, buy rooms and pay, that is a transaction. So the accounting circle tells us, okay, once he pays, what happened? You identify and analyze the transaction. So how do you identify? When the customer pays, it goes to revenue. And when he pays, where did he pay? He pays with his card, it goes to our bank. So what do? We are debiting our, you see, now, once you identify, the second one says you record transaction in journal. How do I do it? I'll debit my bank because he has paid with his card, and I'll credit my revenue, sales for the day. Now, you post those journal entries to the ledger. Now, the ledger means individual of those items. Once now, at a point, we're going to be looking at the simplest form of using accounting software. We'll see how it works, then you understand. But don't worry, that will not come up in the exam. It's just for our knowledge. So when you post into the ledger, then those items from the ledger moves into the trial balance. And trial balance is an accounting document that enables us to ensure that all our posting in the books are correct. It shows the accuracy of all our posting. So where your trial balance is not equal, the debit and the credit are not equal, then that means you need to go back to the beginning. You've done a wrong posting somewhere. Now, the number 5 says adjust entries at the end of the month. Who can tell me what this means? Adjusting when the account has balance in trial balance. Don't mind me, I'm just joking. Adjusting means, at the end of the month, not all the goods you purchase for use for food production are consumed. Not all the beverages are used. You still have some beverages in your fridge, in your store. Not all the things you buy for your rooms are consumed. You still have your toiletries in store. All these items are work in progress. So you are going to calculate their value, and that is the adjustment. Whether you are using LIFO or FIFO, we'll be discussing that at the second semester. Then you are going to adjust it. So for example, if I made a purchasing of things worth 1,000, and at the end of the accounting period, maybe weekly or monthly, I realize the stock remaining is about 200. Adjusting means it's going to reduce what I'm consumed, not 1,000 that I purchased, but 800 is the consumption, and that is what reflects in my books. While the remaining 200, I'm not going to throw it away. Then it goes into my stock inside the balance sheet. So you can see, and once you finish the adjustment, you prepare your final statement, and then you close all temporary accounts. So every transaction passes through this accounting cycle. And your accounting cycle to some organizations are daily, some are weekly, some are monthly, some are annually, but it closes at a point. It doesn't just keep going. So I've given you an example that we see. You record the sales of 500 naira in cash, you debit your cash 500, and you credit your revenue 500. So now we talked about the double entry principle. Now we need to talk about accrual and cash accounting. In some books, you see it as accrual concept, cash concept. Now, when you are setting up, when a business is starting, each business choose which to use. So it's either you use accrual concept or you use the cash concept. So what is the accrual concept? Accrual concept is assume that expenses and income are recorded when they are earned, when they are consumed, when it leaves your unit. Now, remember, I didn't talk about money here. When that transaction has been consumed, it must be entered, it must be captured. So it means if I'm supposed to pay your salary by 28th of February, and I did not pay on 28th, accrual concept says you need to capture it because the staff have worked for me in February. So I need to capture the expenses in February. You can now see. And it follows the same, you have to match it to salary, etc. And this is what is used. Accrual concept is used by most business, profits-oriented businesses. Now, what is the cash concept? Cash concept says we're going to only record our transaction when we have value for it. And we ask, what kind of business will do that? Probably NGOs, like our churches. Imagine somebody promised a church 10 million naira. Will the church capture it into their books that somebody has given them and they will now be knocking his door that pay us, you are owing us 10 million? No. He has promised, they'll wait. So he can promise in January, it will not enter the accounting books. It can be in the promissory book somebody has promised us. Now, if the man pays in November, even from the 10 million, if he pays 2 million, it's the 2 million that they received that will enter November. We have received 2 million. So you see, so this is the kind of accounting people who receive donations use cash concept, because it is when the money is paid, you receive the money, you enter it. Now, let's now try and look at both. You know, I explained accrual concepts. Even if you have not paid, you have to record it. Unlike cash. So, for example, now, I didn't pay you salary on the 25th, on the 28th of February. Maybe peradventure, I decided to pay. Okay, let's assume we're looking at January. I didn't pay on the 31st, and I decided to pay on the 10th of February. Now, you'll be saying, but I made payment on February. Now, why did it not enter the books? Yes, it will enter when you use the accrual concept. Now, this is what has happened. You know, as at 31st of January, using accrual concept, maybe all my staff salary is 1 million. So at the end of January, because I need to close my book, I will post it, salary for the month as an expenses, 1 million. But have I paid for it? No. So I'll go to my liability. I'm owing staff 1 million. You see now, 2 ways it has entered. Who is receiving expenses, salary expenses, debited 1 million, then I'll credit my liability, salary outstanding 1 million. Now, on the 10th of February, I decide to pay the salary 1 million. How do I treat it under accrual concept? Very simple. Now, where is the money coming from? From the bank? Yes. So I'll now say, who is the giver at the bank? I'm going to credit my bank 1 million. Then who is receiving? It's surely the staff, but not the salary expenses, because I'm paying a debt. So I will be debiting my salary in the balance sheet, which will be the salary outstanding that I've posted in January. Then that will be the receiver of the 1 million. So by the time I'm looking at my book, it has been paid. You can see that's how it works. But don't worry, don't be confused. It's just for you to understand those ideas. I'm not going to bother you unnecessarily. And then that is all you need to grab at this point in time. So what is the takeaway in this class? We've looked at the general acceptable accounting principles, where we'll be made to understand that it's give standards on how accounting books are to be prepared. And then we also talk about the double entry principle that says anything that has a debit transaction must have a corresponding credit transaction in our books. We've looked at the accounting circles. Yes, we discussed the gap principles, where we talk about the consistency, the going concern, the matching principle, and the rest. Also, we look at the accounting circle, all the transactions out from the source till the closing. And then we also discuss accrual accounting concepts and also the cash accounting concept. So if you have any question, please feel free to drop on the platform and I'll surely attend to you. You'll be hearing from me before the end of the day as well. Thank you and God bless.